Well, with fiscal policy, we're talking about essentially deficit spending for the government. So you're either increasing spending or you're cutting taxes or some combination of both. And since the November election, we've seen a lot of optimism in the stock market that there's going to be some major infrastructure spending program and that we'll see major tax cuts. I'm not too optimistic about the infrastructure spending. I think there may be a lot of resistance, particularly in the House of Representatives. There's some reluctance to increase spending and increase the deficit there. But tax cuts, I mean, that's what Republicans do. So it's very likely that we will see some agreement to cut taxes for households and businesses. And most of those are going to be geared towards the upper income households and large businesses. You may get a little bit of business fixed investment increase associated with those tax cuts. You're probably not going to see much of an impact on consumer spending because the upper income households tend to save a lot more than they spend. But now the important question is, how does the Fed respond to that? At this point, you're looking at an economy that's pretty close to full employment, which means that if you try to stimulate the economy even more, it's less likely to show up in growth because you've got these limits in the job market. And it may be more likely to show up in either higher inflation or asset price bubbles. So it could be housing, it could be the stock market. So this is very much of a concern. So the Federal Reserve has been very gradually normalizing monetary policy that is raising short-term interest rates. Now, we started 2016 with an expectation that the Fed would raise rates 4 times. Instead, they raised rates just 1 time in December. And looking at 2017, most Fed officials expect 2 to 4 rate increases. And it's going to be data dependent. You know, if the job market tightens a lot more, the Fed could go faster. If the economy's weaker, then the Fed could be more gradual still in raising short-term interest rates. But now you put in fiscal policy, and as such, it may mean that the Fed may be more aggressive. And we heard the comments from the FOMC minutes where many Fed officials worried that if we do see a large fiscal stimulus package, the Fed may end up being a little bit more aggressive in raising short-term interest rates. So again, the idea is we may not see a whole bunch of improvement in the pace of overall economic growth, but we may see higher interest rates along the line.